look at an example of this is just a small part of the stabilization policy model which is going to be coming up. Here I'm going to be talking about central banks as enablers. So just to give you an example, this part focuses on central banks and its key mandates. So this is a small subset of the bigger module. Now, when we are looking at central banks, we want to look at some of the key functions. One of the most important function is to promote monetary and macro stability. Now, a lot of banks have different mandates. It could be either dual, it could be or hierarchical, which is actually one you will be looking at. You could be looking at two options. So some of the mandates you could look at is price stability, maximum sustainable employment growth, currency stabilization. Now we look at how different banks have their own agenda. The second most important part is to promote a sustained and efficient financial system, implement rules and regulations which bring in stability to the financial world or the economic stability. And one of the key important is to have a smooth payment system, smooth running of the payment system within the economy. Now in this particular aspect, today I'll be talking more on how they promote specifically the monetary policies. We'll be looking more towards the monetary policies as in this particular module. In this here, I've taken an example of Central Bank of New Zealand or the Fed. Now, this is a part of a dual mandate. When we talk about central banks must be looking at stable prices, what are we talking about? It is either they can target price level or they could target a percentage change in the price level or inflation. The second is maximum sustainable employment. Now, these two are known as the dual mandate. Some of the banks only target inflation, and some of the central banks have different mandates. We'll also see Central Bank of China and how it's got a different mandate. But in this case, when you're talking about dual, both of these mandates are important. Now, this is taken just to give you an example. Now, when we talk about inflation, and this would keep coming in, what are we talking about? So there are two types of inflation, and we'll discuss this in depth also with example. One is demand pull, where goods and services exceed the supply of goods and services. When we talk economy is very hot, buying and selling is happening more. This is the demand pull side. The other could be push side. A lot of times it could be the input of goods and services. Price of the inputs of goods and services increases. Import of prices, it could be the capital flows or an exchange rate, especially for an economy like India. An exchange rate would be very vital. Now there is some study done, and I'm going to share it at a later date. This is just to give you a fair idea. When we're talking about, there are two types of factors which could influence inflation. Now when we are looking at monetary policy, we are again, just to put a macroeconomic sort of policy, I'm talking about maximum sustainable employment, because in this series ahead we look at Phillips curve. But right now, if you look at it, the major part of the central bank is to set up interest rates, the short-term rates, and that is what they said, which effectively becomes the short-term rates or the lending rates, which becomes the benchmark for prime lending rates. The other is to moderate long-term rates. Now this is very important. We'll understand when do the central banks try to moderate long-term rates. They do it by buying and selling of long-term bonds, usually buying of long-term bonds when we talk about asset purchases or quantitative easing. We are talking about monetary and fiscal policy. We are only going to be talking about monetary policy here. Fiscal policy is something which I've already talked about. Now, when we are talking about fiscal policy, we have seen government taxation. You can refer to the modules before. And today, when I'm going to be talking about, I'll be talking about open market operations, how the change in money supply changes, and a bit more. So just to sort of give, all these policies are to sort of boost aggregate demand, which is what we need during the time of a recession or contraction. We want to boost the aggregate demand. Now, I will be just touching upon modern monetary theory with an example. This is just to will not be going deep into any aspect of these theories. Look at modern monetary theory. What it means is that deficits don't matter, and you can keep printing money as long as you can borrow money in your own currency, because you're printing. What it says, you can use printing press to sponsor budget deficit. Now Mr. Powell, who's heading the Fed chair, and this is not what is believed by the middle road. Now, this clear-cut analysis, which says that this is something which is not justified. Various administrations have done it before, and it's not sustainable. The U.S. debt anyway is very high. As a percentage of the GDP is more than 100%. It's the debt at this point of time is about, the last figures which I have is around $28 trillion. I've taken Jan 2000 and from Jan 2020. So if you take Jan 2000 as the index, which is like if taken as 100, now I want to see how much debt, public debt as a percentage of GDP has increased over time. So in the last 2 decades, if you see, it has increased by 138%. So this data, not the data of US debt as of March 1, there's the total US debt is about $28 trillion. That's from a different source. That's from thebalance.com. But if you look at this graph, so what it means is like in Jan 2020, the debt was about 238% as the public debt as a percentage of gross domestic product was 238%. But if you look at total debt, and we have look at the US debt, that is about $28 trillion. Now, when we look at lending as a last resort, we'll be looking at what are the major tools central banks have. Now, when central banks actually basically use 3 types for lending as a last resort, they use lending, borrowing, and the open market. And we look at what is open market for repo, reverse repo. They purchase assets or quantitative easing in open market to expand reserves of central bank. Third is distressed lending. So they can do during the times of financial crisis. We have seen Great Recession. When there is a systemic risk within the system, the central bank or the financial system can ask for distressed lending. So these are the 3 major tools when we are talking about as a lender of last resort. The central bank has many other tools for regulating money or for regulating liquidity within the system. Here I was talking about when we looked at the mandates, these are the central banks when they are only targeting inflation. That is their top agenda, and they could look at others also. So these are Canada, United Kingdom, Sweden. Sweden is the oldest central bank in the world, Australia, and ECB, European Central Bank. Whereas whenever you're looking at dual mandates, I talked about sustainable employment and inflation. So that's US and New Zealand. But if you're looking at Central Bank of China, it looks at stability in the value of currency and to promote economic growth. Whereas India looks at price stability and economic growth. Now, whenever there's price stability, predominantly they are targeting inflation. So the question is, what are reserves and repo rates? So reserves are the cash which the bank's going to be holding either in vault or with the central bank. Now this is in order to manage the liquidity. There should always be some amount of liquidity within the banks. Now they can central banks can infuse reserves into the system through the repo market, which is what basically they use. Repo are repurchase agreements that are short-term secured loans wherein a party buys the securities from the other party so that at a specific time in the future it's going to buy it back at a rate, and this change in price is known as the repo rate. So if I'm going to sell and I'm going to buy back after some point in time, I'll always be buying it at a higher rate, and which is basically the interest rate on that particular buying of the secured loans. Now this is a very good way of actually managing the liquidity and reserves in the system, and we are going to look this as we go forward. So I talked about the repo rate, and just to sort of give you an example. Now let's say you have bought the securities at 10. At a later date, which is a short period of time, it could vary, you sell it for 12. So the difference between 12 and 10, this is the sort of amount which you bought, that 2 would be annualized. Depending on the days, you'll annualize the rate, is the rate on that particular security. Now when we are using other monetary tools, there's also adjustment of reserve requirement ratio. This is also used as this just to sort of give you another aspect of what monetary tools central banks use. There are quite a few tools. If you look at the Fed has now come out with many tools which you could go and discover yourself. So when we are talking about open market operations, this is actually very important. We need to understand how the central banks operate in open market operations. Now, usually when you're talking about repo and reverse repo rate, it's temporary open market operations. Changes the reserves and liquidity within the system. Now, this is where, for example, it to regulate the Fed funds rate. This is how the central bank, the Fed central bank, would do the process. Now, in terms of quantitative easing on asset purchases, is basically when the interest rates are zero. You cannot actually reduce the rates. What you do is like you purchase assets on an outright purpose. It increases the aggregate supply of reserves or the money supply. The whole idea is to again encourage lending and investment within the system. So this is whenever you're talking about quantitative easing. So when you're buying long-term bonds, that's what the Fed usually sovereign bonds are purchased in open market operations. However, a lot of central banks have gone and purchased mortgage-backed securities. Now we look at an example. If I've seen the Bank of England balance sheet. You can see how much it has increased over the last few months or a year. Now you look at the central bank has increased. It's gone up to about $1.3 trillion. If you look at pounds, it's about 943.7 billion pounds. So there's a 57.28% increase during the time of which I've shown. This is just to give you an idea, during the time of pandemic or during time of when you have really crisis, how do central banks increase? The whole idea is to increase the aggregate supply. I'm talking about aggregate supply of central banks permanently. I forgot to mention what I'm saying is it changes the aggregate supply of liquidity reserves or money supply within the system. Now, when we are talking about moderate, so I'll take few examples of what the asset purchases, which I said you could buy long-term bonds, and we look at quantitative 1 and quantitative 2 and quantitative 3 easing in the next slide, whereas we understand a bit more about quantitative or asset purchases. Taken the total asset purchases by the Federal Reserve over a period of time. So you're looking at from August 2007 to Jan 2021. Now you can see how there's been an expansion of assets, right? So you have Q1, which is where I talked about they started buying mortgage-backed securities. Then you have Q2 and then you have Q3. So in Q3 you have Q1 plus Q2. In Q2 you have they announced the purchase of long-term securities. Now if you compare when you buy long-term securities, when the Fed starts or central banks start buying long-term securities, you are basically bringing down the yields of the long-term securities, and we'll see that over a period of time. Now if you see the curve, there's a time of normalization and trying to reduce the balance sheet. That was when the US economy was performing good, and then there's the time of the pandemic when again you see the asset purchases gone up because interest rates are pretty zero and you had a lot of stimulus which was coming into the economy, and you can see the sort of stimulus which has happened and how much purchases by the suddenly has shot up during the particular period. This is an excellent example because it covers a lot of period. I mean, before the 2007, if you see the Fed had the look at the money supply or how the asset purchases have actually gone up. Just if you look at the asset purchases which has gone up, which means how much money supply has increased over a period of time during that time, because all these asset purchases actually pumping up liquidity into the system. Now we are going to come and see how that happens. So you have open market operations with the central bank scores, buys bonds or sells bonds. Now the whole idea is to change the liquidity within the system. So let's see what happens when the central bank is actually buying bonds, increasing the liquidity within the system. When it is selling bonds, it's sucking up the liquidity. So here we see when they're selling the government bonds, it sucks up the liquidity from the system. Basically, you are increasing the nominal interest rates within the economy, and we'll see how that happens. Whereas when somebody is buying government bonds, you add up liquidity within the system. Basically, you're decreasing the interest rates within the system. So when you're buying bonds, you're actually paying money for that. So you're buying bonds from authorized dealers. You will pay the money, and that particular money is basically, you could say, you're increasing the reserves, which is basically the liquidity over in the system. Example, you have a central bank which pays cash to buy bonds from the authorized dealers. Now the liquidity within the system increases, and the nominal interest rates, which is what is very important when you're talking about nominal interest rates. Is the rates which you can take, bonds pay for you. So nominal interest rates fall. Basically, it could be the short term and the long term, which I talked about, long term purchase, which the Fed did. Now, what you are doing is actually you're putting in a lot of liquidity, you're boosting lending or credit within the system. Go forward and look at the macroeconomic theory. I just want to discuss this. It's very important to discuss the aspect of the change in the nominal interest rates with real money balances. Now, this is what I was talking about. Let's see what has happened over the long term. I took out the data. This is OECD, and they've taken long term as government bonds as maturing in 10 years, which is the most liquid. Usually, these are known as intermediate bonds because till 12 years take intermediate bonds and long term bonds above that. But what you see is that the bond purchases have gone down, brought down the yields. If you look at my global bond market tutorials, you'll understand what the yields is. Basically, what it's showing is like when you're buying, the prices go up, and that's how the yields are coming down. Now, this is a very important aspect I'm talking about is theory of liquidity preference. This is given by John Keynes, and this is the part of ISLM curve which you'll be looking at. But right now, we'll just look at what it means. We have looked at quantitative theory of money. You should go back and look at all the modules on the middle road. So Py is equal to mv, where m is money supply, v is the velocity of money which is fixed, and py is the nominal output, which is the price level into output. So when we are looking at that, the nominal output. Now m by p is actually a fixed supply of real money balances. When you look at real money balances, it means what is the purchasing power of your money. So interest rate is one of the determinants of the how much money you can hold, but it determines the real money balances demanded. So the central bank is the prime source of putting up liquidity into the system. Money balances supplied, if putting m and p as constant, would remain constant. The one way you can change is m. So that is, the more liquidity the central banks puts in within the system, you can change the real money balances supplied. If we look at this equation, we understand that interest rate is one of the determinants, not the only, but one of the determinants of how much money people could hold. So it goes through the demand side, whereas in the supply side, interest rates do not influence the real money balances supplied within a system. Since we are talking about this, there is an inverse relationship between nominal interest rate and money demanded. So if you look at, if interest rates, the nominal interest rates decreases, it's what happens, it's the opposite of the opportunity cost of holding the money decreases. So what it means is the quantity of money demanded increases. So whenever interest rates are going to go down, or whenever I'm putting up liquidity into the system, the supply curve is going to shift towards the right. So the real money balances, the supply of the real money balances shifts to the right. The equilibrium, which is point A, is where the real money demanded is equal to real money supplied. In this particular example, I'm going to be talking about what happens when the real money balances, or when you are putting up or adding up liquidity into the system. Described above, when you add up liquidity into the system, the nominal interest rates are going to reduce because the supply curve we just saying is shifting to the right. The supply of real money balances is not dependent on nominal interest rates. It's supplied by the central bank. Now, when the rates come down, the opportunity cost of holding money decreases. So that's why there's much more money within the system, and the demand for real money balances increases. See, from A, the new equilibrium point is coming at B, and we have the interest rates have gone down. The nominal interest rates have gone down from point A to point B. We are talking about policy, they've got lag. So it could be inside lag, which is when your time taken when there's a shock to the economy, like during the pandemic, and what is the corrective action which you have taken. Or it could be when you have implemented a policy, and when do you see the influence on the policy. For example, one good example is inflation. You might want to see inflation, and let's say there's a lot of asset purchases and you don't see it. It could be also because it takes a lag period is about 2 years. In this example, because inflation could be one example.